Now let's discuss the first method of capital budgeting, that is payback period method. First, let's see what is the meaning of payback period. Okay, payback period is a period at which we get back the originally invested amount. In simple and in short, if I have to say, payback period means after what time your invested amount will be returned. Okay, let me repeat again. Payback period means after what time your invested amount will be returned. So you will be having two situations here. First situation is when returns are constant. Returns means cash inflows. Okay, when cash inflows are constant. The second situation is when returns are not constant. You can say it as uneven cash inflows. Okay, so these were the two situations which you can see in the questions later on. Okay, under payback period method. So let's see with the another concept, that is accept reject decision. So based on this concept also you will be having problems regarding selection of the projects. Okay, which projects to be selected and which project to be rejected. Okay, this concept we will be looking while solving the problem itself. That time you will get the clear understanding regarding that concept. Now let's see how to identify whether the question asked is regarding situation 1 or regarding situation 2. First situation says that when returns are constant, and second situation says that returns are not constant, or you can say uneven cash inflows. I'll take you to the questions. We'll be solving the questions later on, for only for the purpose of identification. I'm showing it now. Okay. A project requires 50 lakhs as an initial investment and 6 lakhs as annual cash inflows. Annual, the word here, annual cash inflows. Okay, means every year this project is generating 6 lakhs. Okay, every year. For year 1, it is generating 6 lakhs. Year 2, it is generating 6 lakhs. Year 3, it is generating 6 lakhs. This is cash inflow, or you can say returns. Okay, I'm not solving this. Please remember, we'll be solving it later. Okay, here what is the meaning of word constant? Means same. Okay, for year 1 also it is 6 lakhs, year 2 also it is 6 lakhs, year 3 also it is 6 lakhs, and so on. Okay, as per the duration of this project you can see. Okay, here returns are constant, so this is regarding situation 1. So this is the way of identification. Okay, now let's see regarding identification of situation 2. Look at this question. A project requires cash outflow of rupees 20,000 and generates cash inflows of 8,000, 7,000, 4,000, 3,000 during the next 4 years. Means here the duration is given. Look at this. Year 1, 2, 3, 4. Okay. First year 1 it is generating 8,000. Year 2 it is generating 7,000. Year 3 it is generating 4,000. And year 4 it is generating 3,000. Okay, please bear with my handwriting. Okay, this is cash inflows. Here, or you can see it as returns also. Okay, here you can see that returns are not same. So we are saying it as uneven cash inflows, or returns are not equal. Okay, so it is regarding situation 2. Now let's discuss the first situation under payback period method, that is when returns are constant. So there is a formula for this. Okay, payback period is equal to initial investment divided by annual cash inflows. Okay, so if you find it difficult to remember, I'll just give you a keyword. Okay, you can remember this formula by outflows divided by inflows. Okay, outflows divided by inflows. Okay, you can remember this formula, but don't write this formula. Okay, you have to write this formula itself just for remembering purpose. Now let's solve some questions under payback period method when returns are constant. Okay, so the first question is, a project requires 50 lakhs as an initial investment and 6 lakhs as annual cash inflows. Calculate payback period. Now by looking at this question, you came to know that you have to solve using payback period method. So here in this question, they have given that initial investment is 50 lakhs and annual cash inflows is 6 lakhs, right? And what's the formula now? Payback period is equal to initial investment divided by annual cash inflows, right? So now let's substitute this values. Okay, 50 lakhs is the initial investment, right, divided by annual cash inflow 6 lakhs. While solving this, you will get 8.33. So this 8.33 is nothing but years. Okay, this is payback period is the regarding years. Okay, as you have seen in the meaning of payback period, after what time you are going to get the investment. Here the time is years, so the answer is 8.33 years. Now let's look at the second question. Question number 2. Cash outflow is rupees 10,000 and it generates rupees 2,000 every year. Here in this question, initial investment, the word is not given directly, and annual cash inflows also is not given directly. Okay, so look at this, cash outflows, right? Cash outflow is 10,000. So what is this cash outflow? That is initial investment. It generates rupees 2,000 every year. Every year means annually, right? So this 2,000 is annual cash inflows. So payback period is equal to initial investment divided by annual cash inflows is equal to 10,000 divided by 2,000. Okay, while you solve, you get 5 as the answer. This 5 is nothing but years. So 5 years is the payback period. After 5 years, you are going to get rupees 10,000. Let's solve a tricky question under payback period method. I hope you have watched the concept building video which has already been uploaded in the YouTube. Okay, if you haven't watched that video, then go to the playlist of my channel. Then under that you can see investment decision, financial management. In that playlist you can get the video regarding investment decision, theory and concept building. Okay, then first watch that video, later on watch all the other videos. Okay, this is my humble request to you all. Without wasting time, let's start the question. Okay, question number 3. A project costs rupees 10 lakhs and yields annually a profit of 90,000 after depreciation at 12.5% per annum, but before tax at 25% for 8 years. Calculate the payback period. Now you have understood that this question is regarding situation 1, right? But you can't solve this question directly like previous questions. Okay, here look at this. Yields annually a profit of rupees 90,000 after depreciation. Okay, at 12.5% per annum, but before tax. Here two main keywords. Look at this, profit of rupees 90,000, right, after depreciation but before tax. What does this mean? I hope you are thorough with the concept and the format. Okay, this is the format, right? Profit after depreciation but before tax. I have taught you this in the concept building video, right? This means cash flows before tax after depreciation, right? The same thing we have to use here. Let's solve the question. Okay, so I have already drawn the format. Okay, first CFBTD won't come, depreciation also won't come. Here the question given is regarding profits of rupees 90,000 after depreciation before tax, right? So this is CFBT. So CFBT is 90,000, right? CFBT is 90,000. Now you have to deduct taxes. tax is given is 25%. Tax is given is 25% on what? 25% on CFBT on 90,000. Okay, 90,000 into 25 divided by 100. So the answer will be here 22,500. Okay, now after deducting 90,000 and 22,500, you will get 67,500. So this is CFATD, cash flows after tax and depreciation. Okay, now this step we have to add depreciation. Now we have to calculate depreciation, right? So in the question, 12.5% per annum is the depreciation, right? So 12.5% into in the question, look at this. A project costs 10 lakhs, right? On this value, you have to charge depreciation. Okay, on 10 lakhs, you have to charge depreciation because it is the cost of the project, right? So 12.5% into 10 lakhs. Okay. So the depreciation value will be 1,25,000. Okay. In this step you have to add. Okay. This step you have to add. So 67,500 plus 1,25,000. The answer will come up to 1,92,500. 1,92,500. So this is the value of cash inflows, or you can call it as CFATBD, cash flows after tax before depreciation. You require this value. As I have already discussed in concept building video, I am repeating it again and again. Okay, so that you go and watch and get clear with the concept, and later on come to watch this video. Okay, so now let's solve the PBP. Let's find out the PBP. Okay, so payback period is equal to, you have to apply the formula here. Initial investment divided by annual cash inflows. Okay, so this is the formula, right, for situation 1. So now let's substitute the value. Initial investment, the cost of the project, right? So cost of the project is 10 lakh rupees. 10 lakhs divided by annual cash inflow. Cash inflow means CFATBD, this value. Okay. 10 lakhs divided by 1,92,500. So if you divide this, you will get 5.20 years. Okay. So this is the answer. So after 5.20 years, you are going to get the 10 lakh rupees amount. Okay. Please take down this solution, and for your information, you need not write this step. Okay, just for understanding purpose I have kept. You can directly begin with CFBT. Okay, you can directly begin with this step. No need to write this thing. Okay, because in question it is directly given that the profit of rupees 90,000 after depreciation but before tax. It is given there, so you can directly begin with this. Let's solve uneven cash inflow case questions. In the next video, I'll be numbering the videos in thumbnail. According to that number, you can watch directly in the playlist. Okay. If you were able to understand this video very clearly, then please give a like to this video. Please subscribe, give your comments, and please share it with your friends.